One of the challenges, I think, or raps against maybe VC is that 4 to 6 year exit, right? You've got investors, they want their money back, they want a return. Who knows where the market will be 4 to 6 years? Could be a terrible market, could be a great market, but don't know, can't control that. May have investments that need more time to fulfill, the expectations. How rigid are you in that? And is that something that is a challenge for Grayhawk, for your firm?
Timing is everything.
Yeah.
And majority of folks that are investing in venture capital understand the longevity of the investment and the relationships that go along with it. And that there's different cycles. You can have great cycles, or you can have cycles like you've seen over the last 4 years or so. The DPI, distributed paid-in capital, is very, very low, and in some cases non-existent. I know that when I've raised capital, currently raising capital, I am very verbal about the cyclicality of market, but where the outsized returns that you can get in venture capital outweigh sometimes the patience that's needed to be able to harvest those investments. So I think communication is absolutely key in letting investors know what your expectations are, what different scenarios and outcomes are possibilities, and having that communication with them. And generally, those folks who've been around for a while, family offices, institutions, other maybe people who've been angel investing for a while, they will actually respect that a lot more than you telling them we're going to be able to exit within 4 years or 5 years or 6 years. Now, there are legal mandates within the structure of a fund.
Right.
And in most cases, you have a term fund with a couple of years of extensions possible. And that I've seen that more and more common, of where there are extensions by another 1 or 2 years post the typical 10-year fund. Most LPs are not going to want to take full ownership of their portfolio if that term comes up after, call it 12 years. And they're going to be, they're going to need to suddenly they need to govern their own destiny within those portfolios. Some of them are normally on the back end of a fund. You've either got some great winners, or you've got some of those that refuse to die, right? And so, I mean, funds can go back to the LPs and get input from them. But I think having those communication conversations earlier on when you're raising capital is incredibly helpful.
Yeah, I guess it depends on your investor mix as well, having the right kind of investors that have that mindset and understand the issues.
Yeah, I mean, just like a company has an ICP, an ideal customer profile, I think it's important that firms like ours has an IIP, an ideal investor profile. Understanding who's your target market, who resonates with what you're investing in, the timelines, the cycles, the verticals, whether they want to be proactive in specific areas or whether they just want to be passive investors. For me, the one must have is be a mensch, be a good person. I much prefer to be able to have good people that have capital behind them, rather than having capital that have schmucks behind them.
So can you put that into your data-driven model? Menches, not schmucks?
I've not tried that yet. I think that's maybe a first go-to.
No data out there on that.
I don't. Yeah, I don't think they've tagged the schmucks yet.
Right.
But we do a lot of references on the LPs that we bring in. Most of them are by referrals. So if they come in from good people, and I'm a connector. I like connecting people. And if I have someone from the get-go that I don't think is a reliable, trustworthy, or good character person, the ability, and they need me to, or they request for me to introduce them to someone else, and if I can't do that in good conscience, then that's not an LP that I think is a good fit for the fund. On the other hand, good people, I want to connect them all day and every day to the right people.
Right.
Real quick, just because you said it was interesting, and it was kind of a throwaway comment, but it made me think. You talked about how some fund or some investments, they go to the moon, and some refuse to die. From a VC standpoint, I mean, nobody wants to lose money, but sometimes you're just like, is that thing going to die off? Like, if those refuse to die investments, is it better off that they die off, or is there always, that glimmer of hope it'll come back?
No, I think, I mean, you can get a really good idea from early on whether they're going to have a healthy future or not. There's obviously, as fiduciaries of capital, you want to be able to make the best decisions to be able to get the capital back. I'll give you an example of think about a company that that loses a large customer, call it 50-60%, and they were valued at X valuation, and in a best case scenario, it takes them 4 to 5 years to come back to that same valuation. Or you've got an ability to be able to get some money, call it 40-50 cents on the dollar back. Which one is better use of your time as a fiduciary of capital? Do you prefer to take that 50 cents on the dollar and go and reinvest that into a new company? Or do you prefer to try and hope, and pray that year over year they're going to grow 100% and it's going to grow into the valuation that you invested in them 5 years back? So that would be an example of like which way do you go? And I think the former one of get some money back, redeploy it, rather than hang on to that company hoping that they grow year over year. So I think each one is, you want to be conscious of your time. Like I mentioned, time and people are the most important things. You don't want to be, dedicating time to a company that is going to be, bad for the portfolio. You want to help the people as best as they can, of course. But just to hang on for 5, 7, 8, 9 years sometimes, it's probably not in anyone's best interest. Now, there could be exceptions to it, don't get me wrong, but I think as overall, and that's probably the best approach to take.